Hey guys, hope you're doing well out there. It's time to kick off tech earnings season as we always do by taking a look at Netflix's Q1 report. They're the first of the mega caps to report, and we'll jump into the revenues, the earnings, the all-important global paid membership number, otherwise known as the subscribers at Netflix. We'll take a look at the forecast, both what the company has provided for the upcoming Q2 and what Wall Street is expecting over the next few quarters. We'll also break it down from a regional perspective. This company really still continuing to have strong subscriber growth, both in United States and Canada, but is really seeming to plateau in other parts of the world. Then we'll take a look at some news, both from Netflix and some competitors to Netflix, and see really how they're shaping out. We'll jump into the financials from a cash flow, balance sheet, and statement of income, and then as always, jump into the technicals. This one is now looking to roll over as shares are declining in the after hours after this Q1 report, but you are still sitting on a mega, and I mean an absolutely mega uptrend. We trace it back to their IPO days back in 2002, and you have this nearly 20-year uptrend acting in your favor, and within that you also have a smaller uptrend. But as shares are looking to roll over now, we'll outline some levels where I think you can step into shares of Netflix, or if you already have a position in a stock like this, where I think you can continue to add to your position. So we'll jump into all of that. I'll share my thoughts on Netflix, and as always, if you are new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Shares of Netflix declining nearly 3.5% in the after hours, giving up some of those one-year gains of closer to 84%. That is an absolutely staggering gain over the past 1 year, even just year to date, up nearly 25%. But again, is giving up some of those gains in the after hours. That is despite beating both on the top and bottom line, as top line revenues for this most recent Q1 came in at $9.37 billion. That was good for nearly 15% growth year over year. It did beat estimates on Wall Street, which were closer to $9.28 billion, so nearly $100 million beat on that top line. In terms of bottom line, GAAP EPS came in at $5.28. Again, pretty strong beat by nearly 76 cents, as Wall Street estimates were closer to $4.54. The high end estimate on that EPS side was closer to $4.89, and Netflix absolutely blowing that out of the water, coming in at $5.28. Really, the story as we walk through these results is the fact that Netflix is becoming a bottom line or an earnings focused company more so than a top line company. And we'll really see that as they announced a new reporting structure starting next year in their financials. But we'll get into that more later. In terms of the net paid additions, that came in at 9.3 million net new subscribers. That is an extremely strong number considering over the past, call it year and a half, subscriber growth really had slowed down until the previous few quarters. So again, subscriber growth, tremendous to see over at Netflix. In terms of guidance, they're guiding for revenues for this upcoming Q2 to come in the range of 9.49 billion. I'm seeing estimates on Wall Street were closer to 9.53 billion. So Netflix coming in just shy, call it $50 million underneath Wall Street's estimate on that revenue side. In terms of EPS, coming in at 468, consensus was closer to 454. So again, like we said, this company is outpacing Wall Street expectations on the EPS side, but coming in just shy on the revenue side. So as Netflix moves along in its maturity, it's a company focused more on EPS, focused more on margins and free cash flows, and less so on revenues, at least revenue simply coming from the addition of new net paid subscribers. They have another whole ad tier subscription based model that they're now rolling in and having advertising revenues come in. And so that sort of changes the economics of Netflix's revenues. Maybe a shift on just purely looking at the revenue growth is moving away just a little bit. Now, in terms of this $9.49 billion Q2 revenue guidance, that would be growth of roughly 16%. So still continuing strong growth over at Netflix's revenues. This quarter, we were at 15%. That is looking to accelerate up to 16%. And in fact, over the past 5 quarters, you see revenues have really been accelerating up from nearly 3% up to 8%, then 12.5%, now 15%. And then in the next quarter, expected to come in at 16%. So while Netflix is focusing more and more on operating margins and EPS and free cash flows, they're still just able to continue that extremely strong revenue growth and not just grow it, but accelerate that growth rate as well. In terms of full year operating margin, that they're expanding from 24% up to 25% on their guidance. So along with a healthy revenue growth of close to 13 to 15% for the full year, they're also expecting now operating margins to come in closer to 25%. And really, when we annualize the EPS number for Netflix, at least what Wall Street has as a $17.23 figure on that EPS side, really, in my opinion, I think that is a bit sandbagged. Considering Netflix is coming in with these consistent EPS beats on its previous quarter and also outpacing EPS guidance for the upcoming quarter. So I really wouldn't be surprised if Netflix's EPS for this full year comes in ahead of $18. That would bring their forward priced earnings, I'd say, closer to 30 times, especially considering the fact shares are declining also in the after hours. And so for a company that you're paying, I'd say, closer to 30 times on an earnings multiple, still expected to grow north of 40% on their bottom line, I think that's actually a pretty attractive valuation, despite the fact that you have shares run up nearly 90% over the past 1 year. And so that's something to keep in mind. Along with a extremely strong EPS figure, you're continuing your operating margin expansion, as that is now up to 28%. That's a nearly 7 percentage point jump compared to Q1 of last year, where we were closer to 21% on our operating margins. And then in Q2, Netflix is guiding for another 26% operating margin quarter. So the operating margin's really looking extremely strong. We had a period of slower operating margin growth, but really I think three things helping this operating margin expand. The first is their crackdown on password sharing, which has proven to be wildly successful. I think that as we move along in the quarters will continue to slow down, considering majority of that has been realized. But then also you have a wildly successful advertising tier continuing to just ramp up, as the majority of their net new ads are on that advertising tier. And then lastly, you have an extremely strong slate of content continuing to flow through Netflix, along with must-watch live events. And so things like that, just continuing to boost viewership over at Netflix and continuing to have them add new subscribers. As we see in this most recent quarter, they added nearly 9 million new subscribers for a growth of nearly 16% on that global net paid ads. So extremely strong growth, both from a top line, a user, an operating margin, and an EPS perspective. So Netflix really chugging along all in the right direction. Along with that, you have the qualities of a good company continuing to buy back their own shares, despite, again, a tremendous rally in the stock. Netflix continuing to return cash to you, the shareholders. So really, this company doing all the right things and chugging right along. Now, despite all of that, I think Netflix does have some challenges, especially in the regions outside of United States and Canada. So if we take a look at Europe, they're sitting on roughly, they added close to 3 million net paid ads, which is still an extremely strong number, not as strong as their Q4 where they added closer to 5 million, but still a $3 million net new paid additions, pretty strong number. Where they are experiencing some challenges is the average revenue per membership, as that is basically flat on a year-over-year membership at close to $10.92, nowhere near the United States and Canada average revenue per membership, but still not even increasing incrementally. And really over the past few quarters, that has flatlined to gone down. So I think the average revenue per membership, both on the Europe, Latin America, and Asia Pacific markets, has really plateaued. As you see in Latin America, average revenue per member actually declined 4%, and then in APAC declining nearly 8%. So while they're still adding new subscribers in these regions, the fact that their average revenue per member isn't really able to go up and is in fact declining might be showing signs that this company, really on a pricing power in those regions at least, has sort of plateaued. Completely different story in United States and Canada, as the average revenue per member is still growing pretty aggressively, as that's up to $17.30. Last year you were closer to $16.18. And then on top of that, you had nearly 2.5 million new net paid ads on a subscriber basis. So while United States and Canada growing both from a subscriber and revenue per member perspective, the other regions not really growing on that average revenue per member nearly as fast. And so maybe those regions Netflix is looking to have plateaued, at least on their pricing. Now, this news coming out earlier in the day that Disney and Warner Brother Discovery is not likely to make an NBA deal before the exclusive window closes. And so this really affects Netflix, not directly, but in an indirect manner, as there's a media rights deal, or we call it media partnership, that these streaming giants really have to agree to with these live sporting organizations like an NBA, like an NFL, or an NHL. And so these sort of media deals tend to occur every 10 years, and then after the end of that, they tend to get renegotiated. And so back in 2014, the NBA inked their deal with Disney and Warner for nearly $24 billion. This time they're looking to double that, closer to $50 billion would be my guess. And because Warner Brothers or Disney likely will not reach a deal before the end of the deadline on April 22nd, that allows other media outlets like an Amazon, like an Apple, even a YouTube or Netflix to come in there and secure that media rights deal. Now, in my opinion, for Netflix, this is really something they've said they're not looking to do, which in my opinion is a good thing. Netflix really wants to focus on those one-off, must-watch, high viewership events like a Jake Paul, Mike Tyson fight, I think it is better for Netflix to let these other streaming giants sort of battle it out and really compete for a media rights deal, which in my opinion is pretty expensive and time consuming to figure out, and in the meanwhile develop pretty compelling docuseries regarding these sports, or just have those one-off must-watch live events. And so Netflix staying away from the media rights for those live sports, I think, in my opinion, probably a good thing. Now, Netflix did mention in this press release that starting next year in Q1 of 2025, that they will stop reporting quarterly membership numbers along with the average revenue per member. And they reiterated that long-term growth will come from improving the entertainment slate, innovating in product, and then tapping additional revenue pools, in particular, scaling the ad business. And so beyond 2025, they don't really see each additional membership having a strong indication of future potential. They really see that each additional membership has a pretty different business impact now that they have their ad tier, and they want to focus on the substantial profit and free cash flow that they're generating. And so again, I think another step in the maturity of Netflix, showing that they're really focusing more so on the bottom line, on free cash flow, on things like margins, rather than just growing their subscriber base or just really focusing on growing their average revenue per member. So again, another sign of maturity for this company. I think that's, in my opinion, a good thing, considering this company really has evolved its business model pretty substantially with the addition of that ad tier. Now, from a financials perspective, like we said, this quarter came in pretty stellar, with revenues growing nearly 15% up to $9.3 billion. Your cost of revenues not really expanding nearly as fast, up just $200 million on a year-over-year basis. Along with that, your marketing did tick up close to another $100 million, but then your technology R&D staying relatively flat on a year-over-year perspective, and then also G&A staying pretty close to being flat on a year-over-year basis. And so right there, you were able to expand your operating income up to $2.6 billion. Last year, you were closer to 1.7. And so majority of that revenue is coming down to your operating income, really showing you the leverage that this company has to grow their operating margins. Along with that, you have basically your interest expense canceled out by your interest income, leading you to a net income figure closer to $2.3 billion. Extremely, extremely strong. Last year, you were nearly $1.3 billion. Along with that, you have a decrease in your weighted shares outstanding. We'll see where that happens when we flow down to the cash flows. First of all, from the balance sheet perspective, assets looking all good, with cash coming in at close to $7 billion, sitting on another $32 billion of content assets. This is really the bread and butter of Netflix. These content assets you can likely put a large multiple on just because of how valuable they are. Another, call it $13.2 billion of long-term debt, which is ticking down, which is good to see. And along with that, you have close to $4.4 billion in content liabilities. So from a balance sheet perspective, nothing to really worry about. You're sitting on roughly $49 billion of total assets, balanced off by roughly $27 billion in total liabilities. So Netflix's balance sheet looking fairly healthy. They do have quite a bit of leverage with those content assets and that $7 billion cash pile. Now we pull down that $2.3 billion net income figure, get to add back some depreciation, some stock-based compensation, which is actually declining on a year-over-year basis. That is good to see. We get to net cash provided by operating activities closer to $2.2 billion. We don't use a ton in investing activities, and then the majority of that is either to repay down some long-term debt and buy back the stock to the tune of close to $2 billion. That has actually accelerated on a year-over-year basis. Quarter-over-quarter is down just a little bit, but the fact that this company is up close to 87% on its stock year-over-year and is aggressively still buying back shares, well, I don't know if that's the best use of their capital, but I'll ultimately let you be the judge of that. All things looking good from a cash flow perspective for Netflix. They're churning out just a tremendous amount of free cash flow and earnings, and so that's allowing them to do that share buyback, allowing them to continue to invest in their extremely strong slate of content and continue to grow that advertising tier at a pretty rapid clip. Now, with all of that, you do have still the shares declining close to 3.5%, call it 4% in the after hours, coming down to $587 a share. The next stop likely for shares of Netflix would be closer to this 500, call it 60, somewhere up to $570 a share. You have a level of support back from January of this year, but underneath that, you do have a large gap. And if Netflix comes in here and breaks this support line, there's a pretty strong chance you're coming in here and filling this large gap, coming down south of, call it $500 a share. Certainly over the long term, this company has been in a nearly 2-year uptrend, and coming down to close to $500 a share, that would be the middle of the range where I think you can pretty easily step into shares of Netflix. Certainly if you don't have a position, opening a position at close to $500 after it fills this gap wouldn't be the worst thing, especially considering the fundamentals for this company really intact. As we saw, the valuation not overly expensive compared to the earnings growth and the free cash flow growth that you're getting for Netflix. Considering that it was trading near the top end of our channel, it's pretty likely that it was to get rejected after earnings. And now that we're seeing that pullback, I think any pullbacks, call it underneath $560 all the way down to $500, I think that is your region to pick up shares of Netflix. Certainly if it comes down all the way to the bottom end of this channel, in my opinion, I think that would be an easy buy the dip opportunity, considering how strong the fundamentals for this company continue to be. Along with that, you have a nearly 20-year uptrend that this company is still making, and so any major dips within that really can be easily acquired, and this company is chugging right along and has a growing slate of content and has a rapidly growing advertising tier as well. So those, I think, are secular trends here to stay with Netflix. And considering that they're still an industry leader with room to expand on their market share in terms of TV viewing, I think those are reasons to continue to like shares of Netflix. That was my take on Netflix. Let me know your thoughts on this one in the comment section below. Are you coming in here and picking up shares on this dip, or are you going to wait for a further pullback, let's say closer to the middle of the $500 range? Let me know your thoughts in the comment section below. As always, thanks so much for listening. Stay tuned on the channel for more tech earnings coming next week, as we have the majority of mega caps reporting somewhere between Tuesday and Thursday. We'll be sure to cover those on the channel, so subscribe to not miss a future upload. As always, thanks so much for listening, and I'll catch you guys in the next video.